Imagine being the unluckiest investor on earth. Every time you have money to invest, you wait until the stock market hits an all-time high, then you invest. No dips, just peak after peak. Most people would assume this person is doomed to fail, the poster child for buying high and selling low. But is that really the case? Today, we're going to explore whether buying at all-time highs is truly worse than waiting for a dip, or if waiting could actually do more damage over time. This video will break down the research, use some math, and hopefully set you free from the anxiety of wondering, when should I invest? Let's meet three types of investors. First, the dip waiter. She refuses to invest when markets feel expensive, always waiting for a correction. Second, the unlucky investor. He invests only at all-time highs, never catching a dip. Third, the fearful saver. This person never invests, letting inflation quietly erode their savings year after year. We already know the fate of the third. Savings lose value over time. But what about the other two? Is buying at all-time highs really worse than waiting for a dip? Or could waiting actually cost more? To answer this question, we need to look at real research and data. Welcome to Mardic Finance, where we explain investing concepts simply. Today, we'll compare two investors, Wendy, who waits for a dip, and Bridget, who invests at peaks. We'll see how their strategies play out over time and whether intuition matches reality. Picture Wendy, the disciplined investor. She never invests at all-time highs, always waiting for a 10% pullback. Then there's Bridget, who invests whenever she has money, always at the absolute peak. Intuitively, you'd expect Wendy to outperform Bridget by a mile. Wendy avoids expensive markets while Bridget buys at the worst possible times. But is that what actually happens? Let's dig into the numbers. Waiting for a dip feels disciplined, but it's still a form of market timing. You're betting that prices will be lower in the future than they are today. The market doesn't need to crash for that bet to fail. It only needs to keep going up longer than you expect. Many investors get stuck not because they were wrong about a crash, but because they underestimated how long bull markets can last. Researchers at Archbridge Family Office analyzed S&P 500 returns since 1990. They compared three strategies: waiting for a 10% pullback, investing at all-time highs, and investing on random days. Surprisingly, investing at all-time highs produced higher average returns than waiting for a dip. It even outperformed investing on random days. This result feels backwards, but it's rooted in how markets behave during strong bull runs. Why would buying at record highs beat patiently waiting for a correction? All-time highs don't happen in isolation. They cluster during strong bull markets, periods of earnings growth and economic expansion. Healthy markets don't hit one high and collapse. They often hit many highs in a row. While Wendy sits in cash waiting for the perfect entry, the market keeps moving higher. Sometimes that 10% dip never comes, or comes much later after prices are already far above where Wendy could have invested. This is the hidden cost of waiting. It doesn't feel risky, it feels safe. But waiting has a price, opportunity cost. While Wendy waits, she misses gains, compounding, reinvested dividends, and most importantly, time. The longer she waits, the more she misses out on the power of compounding returns. Now let's talk about Bridget. If she invests right before a major crash like in 2000 or 2008, her investment takes a hit. The market drops 40 or 50%, painful no doubt. But Bridget doesn't invest just once. She invests every year, through crashes, recoveries, and new bull markets. Her early investments have decades to recover and grow. A market peak today often looks like a valley 10 or 20 years from now. Think of investing like planting a tree. Does it really matter if you plant it on the sunniest day or the cloudiest day? Not really. What matters is that you planted it and gave it decades to grow. The same is true for investing. Time in the market beats timing the market. Now let's talk about psychology. If you've ever thought the market feels too high right now, you're not alone. This feeling is tied to loss aversion and regret aversion. We feel the pain of losses far more intensely than the pleasure of gains. When markets are at all-time highs, our brains scream danger, even though historically, all-time highs are often followed by more highs. Decades of S&P 500 data show that missing the market's best days can devastate returns. Hartford funds found that missing only the 10 best days over a 20-year period cut total returns by more than half. Missing the 20 best days reduced returns by over 70%. Many of those best days happen during volatile periods, right after crashes, when fear is highest. Investors who wait for clarity often miss the recovery. So what's the real takeaway? Should you invest blindly without thinking? Not exactly. Consistency beats perfection. The data strongly suggests that regularly investing a fixed amount, regardless of market conditions, works better than trying to time entries. This approach is known as dollar-cost averaging, and it works because it removes emotion from the equation. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market highs or lows. This strategy helps you avoid the pitfalls of market timing and emotional investing. Over time, it smooths out your entry points and builds wealth steadily. It's a proven approach for long-term investors. Before you rush to invest in a single S&P 500 index fund, consider this. All the research and timing comparisons are based on the US market. What if the US is the exception, not the rule? This matters more now than ever because of concentration risk. The S&P 500 is less diversified than global indexes, and recent performance has been carried by a handful of megacap tech stocks. According to T. Rowe Price, the MSCI All-Country World Index contains roughly 5 times the number of companies as the S&P 500, over 2,500 stocks compared to about 500. When you buy the S&P 500, you're not buying 500 independent bets. Technology stocks alone make up about 41% of the S&P 500, a concentration level not seen since the dot-com bubble. Research from Guinness Global Investors shows that the market cap-weighted S&P 500 is heavily influenced by a small handful of megacap names. If those companies stumble, the index doesn't just fall a little, it falls because of them specifically. This concentration risk is important to understand when building a portfolio. Despite its concentration, the S&P 500 has delivered excellent returns over the long term. It has even outperformed the MSCI World, largely due to the strength of U.S. companies in recent decades. However, it is clearly less diversified than other indexes, and investors should be aware of this when making decisions. So what have we learned? Buying at all-time highs isn't as risky as it seems. Waiting for a dip can actually cost more in missed gains and compounding. Consistency and dollar cost averaging beat perfection and market timing. Diversification matters, especially in concentrated markets like the S&P 500. The most important thing is to start investing and let time work for you. Investing is about discipline, consistency, and understanding risk. The research shows that waiting for the perfect moment rarely pays off. Instead, regular investing, even at market highs, can lead to better outcomes. Diversify your portfolio, avoid concentration risk, and focus on the long term. Remember, time in the market is your greatest ally. Whether you're just starting out or have been investing for years, the key lesson is clear. Don't let fear or perfectionism hold you back. Start investing, stay consistent, and let compounding do its magic. The market will have highs and lows, but your discipline and patience will pay off over time. Thanks for watching Mardic Finance, where we break down investing with data and psychology.